Good morning and good afternoon, everyone. Welcome to the webinar titled The Future of Automated Lending, presented by Newgen Software, a leading provider of a unified digital transformation platform with native process automation, content services, and communication management capabilities, with a multitude of implementations across the globe. My name is Gunjan Kalita, and I shall be your host and the moderator for this webinar. Let me introduce our speakers today. First up, we have guest speaker Jost Hoppermann. Jost is Vice President and Principal Analyst at Forrester. His research focuses on banking technology, applications, and architecture to help clients make the right decisions in a fast-changing market. He helps banks understand the key dynamics of banking architecture and in the banking applications market to make smart decisions. He has been a featured speaker at industry events like Cybos and quoted in publications including American Banker, the New York Times, and the Wall Street Journal. Jost is joined by our guest speaker, Dilnisin Bayel. Dilnisin is the credit lead and reimagining customer experience campaign lead for Accenture in Europe. She is a managing director in the strategy and consulting group. Based in London, Dilnisin advises banks and other financial services companies on how to stay ahead of the significant changes happening in credit, helping them to plan for the future and transform their business. She also leads the Future of Banking initiative for Accenture globally, which highlights new business models for banks. We also have Rajiv Nair, who is a director at Newgen, with responsibilities for UK, Ireland, and Europe. At the end of the webinar, we'll be having a question and answer session. We request you to type your questions in the question window of your GoToWebinar anytime throughout the session. Our experts would get back to them right after the webinar. With that, I hand it over to you, Jost.
Thank you very much indeed. And once again, good morning, good afternoon, good evening, depending on where you are and when you listen to this webinar. And also thank you for the opportunity to talk a little bit about lending, automation, the future of banking, and a couple of other topics that are relevant in this context. With that, without further ado, I would like to start with setting the stage. And we all know that in the previous years, the pandemic has tested everyone. Leaders had to make changes that were previously thought impossible, from accelerating digital transformation to pivoting entirely new business models and delivery platforms. And changed customer behaviors and attitudes were certainly also challenges to many banks during the last few years. And looking at this, we are certainly seeing mass enablement of workforces. The contact center became the front room, and we also saw permanent shifts to hybrid office working cultures and futures. And consequently, in this environment, banks certainly had to accelerate their transformation approaches much more than in the past. And we have seen, to go back to the key topic here, to lending, we have certainly seen a huge improvement when it comes to digital lending capabilities, a much larger improvement than during the years before. And consequently, it's not a huge surprise seeing the benefits of these improvements in front of them. Banks determined that they should do more, but not only on the lending side, also on the automation side. Looking at some Forrester data, we can clearly say that 67% of financial services firms told us in a survey earlier this year that they maintain or want to increase investments in lending systems. At the same point in time, we also found that automation is a key topic. We found that a total of 83% of financial services firms plan to adopt digital process automation, and consequently, there will be a huge overlap with the lending space. In addition to that, we've also seen a strong interest, for example, in low-code development and other topics. Just to offer one example, 44% of financial services firms utilize already a low-code automation platform. However, this is not all what is going on in the industry. many firms already prepare for the future. So let me talk about 4 themes that Forrester has identified a few years ago that we are continuously updating, 4 themes that define the future of banking and financial services in general. What we have seen is certainly that there's a need for banks to support invisible banking. What does invisible banking mean? Many of you will know it as embedded finance. It's about payment mechanisms embedded in a retail website. It's about buy now, pay later. And we are seeing many additional capabilities at the horizon. So it's really about the ability of banks to hook their capabilities invisibly into the business processes of their partners. Brings us to connected, because this will not be limited to working with, for example, retail companies. It will also be about the broader picture, about banking ecosystems, where banks will organize or contribute to an ecosystem that may consist of banks, of other financial services firms, of fintechs, and non-financial services firms in an orchestrated fashion. But this is not enough to be prepared for the future. It's also about insights driven, basically nothing new, but certainly still a huge challenge for many banks to make the best of the data they already have and the best of the data that they may get from outside to make the best possible decisions when it comes, for example, to new products and services, when it comes to risk assessments, the direction of the company, and many other topics. And then it's about purposeful. And one aspect of purposeful, and certainly not the only one aspect of purposeful is financial well-being. The bank should definitely help its customers to be in an environment. However, as the world has changed, this is not enough. Banks also need to make sure that they can offer their customers environmentally positive products and services, for example, in the investment space, that they have a low carbon footprint. And they need to do all of that while looking through 3 lenses, that of the customer, that of the bank, and also of the collaborator, the partner in these ecosystems. Because in the era of open finance, no financial services firm can do it alone, can be successful on its own. This also means that banks have to fundamentally change the way how they work, how they produce products, and how they bring their products and services to the market. In this future, a bank will build and distribute products, but with subtle nuances. These products and services will be designed to support integration, to enable broader distribution models and embedding within other platforms and channels. So it's not only about being a monolithic product manufacturer with a sales channel, it's about being able to play multiple roles, which means it's about connected, embedded ecosystems driven future that will offer multiple routes to the market. It's about being able to consume and being able to supply capabilities to others, be it a marketplace, be it someone else selling the product of a given bank, and so on and so forth. In this context, we are also clearly seeing the emergence of very specialized providers. We are seeing a breadth of capabilities and possession of a banking license that will define various delivery models. Sorry, I will not talk about all of these capabilities at any detailed level. Let me just summarize. On the left side, in the non-regulated column, we are seeing banking capabilities that will be delivered in one way or the other in a SaaS-like fashion. Maybe the complete set of business capabilities a bank needs to run its business, as in bank as a platform. It may be just KYC, it may just be lending, it may just be onboarding that a certain provider will deliver in a SaaS-like fashion. This is really about banking applications that get delivered in the cloud or via the cloud. What we are also seeing as an emerging aspect is to do all that, bank as a platform, SaaS-like, with a banking license. So that, for example, a startup can go very rapidly to market. So it's about having not only the banking applications and the banking infrastructure, it's also about everything a bank needs, including the banking license. And this is what we call banking services. Looking at this, at the various roles a bank can be in, looking at the various partnerships that a bank may use, a bank may contribute to, it becomes very clear that the future of the banking industry will be highly networked. There will be a mesh of partnerships, of interactions, of business relationships. There will be overlapping ecosystems, contributing ecosystems, but also competing ecosystems. And consequently, we are saying there will be constellations of business ecosystems, of banking ecosystems that are emerging, that will reshape the banking industry, or to be more precise, the financial services industry and many of its partners. However, this is certainly not the only thing that we need to consider. It's certainly about the future of banking, but we also need to keep in mind that whether it is today or in the future, we need to consider the customer and the customer experience. So let's have a look at the top 3 ways in which banks can improve customer experience today, not considering the more technology-oriented ways. What we are seeing here is definitely personalization, to offer more personalized services, to offer more personalized products, maybe even to offer personalized user interfaces. In our view, in Forrester's view, personalization is an experience that uses customer data and understanding to frame, guide, extend, and enhance interactions based on that person's history, preferences, context, and intent. Then we need to look at digitization. We will come back to that in a few seconds. And there's also customer service, which is certainly a very broad and rich topic, but let's focus on digitization for now. When we look at digitization, we are certainly seeing that banks are now moving from simple to more challenging, more demanding customer journeys. And for example, we are seeing banks looking at mortgage applications with all the paperwork, to phrase it that way, around it, to make them more digital, to make them more seamless, and to make them more effective. What we are also seeing is certainly commercial origination. Certainly a very complex topic, very similar to commercial onboarding, because there are typically different sets, different hierarchies of employees, of managers, of executives that have to sign certain documents. And consequently, this will be a very tricky process, to use the words again, because these systems need to be extremely flexible so that they can align with a given corporate customer's hierarchy in any given situation. And this basically brings us to a new world where companies in general, and certainly banks as well, need to be in a position to use a digital operating model. They need to be able to, no surprise, deliver great digital experiences so that their customers and their employees can effectively, emotionally engage with them. However, this will not be enough for a number of reasons. They also need digital operations. They need digital operations, for example, automation, but many other things to be more effective with their internal processes, but also to support the digital experiences, because without seamless processes, there can't be a complete and great digital experience. There will always be some kind of missing factor if a customer has to wait too long for a given piece of information, for example. Then, and I guess this is not a huge surprise given the introduction about the future of banking and being connected and ecosystems, digital operations clearly focuses on digital ecosystems, on the platforms and partnerships we already talked about. However, this won't be enough. What we really need to be able to establish, when I say we, I mean many industries, but particularly banking, is to be perfect, to excel when it comes to digital innovation. It's definitely about continuously improving and breaking through at the digital frontier, which means we certainly need great architectures, highly flexible architectures, architectures that support agility, that support new business models, that support rapid change to enable a bank to be successful in all of the three other areas: digital experience, operations, and ecosystems, but also to push a boundary, to embrace new ideas, to differentiate, and to defend the competitiveness that banks urgently need in today's markets. But it's not only about architecture. It is certainly also about emerging technologies. When I say emerging technologies, I mean those technologies that are already usable today, but also those that are at the horizon. And I guess it's good to have a quick look at emerging technologies as Forrester sees them today. And to give you some context, Forrester has published a report on key emerging technologies in banking in early 2022, as we did, for example, in 2021. And we categorized emerging technologies using three reasons, let's say. One of the horizons is hot. Here we are seeing strong interest, high value use cases, certainly also investments on the banking side. On the other side of the spectrum is hype. Here we certainly see to some extent investments, maybe at a lower level. We're certainly seeing interest, but also uncertainty where this may lead to, particularly for the banking industry. And in the middle, we have on the radar. This is a category that sees a mixed amount of investment, a mixed amount of business value. And these topics here, the technologies in this category, represent opportunities for some banks and a waste of money maybe for others. It completely depends on the individual situation. And before I forget it to say that, let's keep in mind that this is definitely about key emerging technologies in banking for banks, and some technologies may be completely different positioned for other industries. But with that, let's have a look at some of the topics here. And don't worry, I will certainly not talk about all of them. Let's just pick two in the hot category. Let's talk a little bit about machine learning. And here we're definitely seeing a lot of use cases related to improved process efficiency, to understanding and working with information, with supporting decisions. And the good news is when it comes to machine learning and AI in general, it's not only about large banks with large teams specializing on using AI, bringing the idea forward. It's also about what I like to call AI-powered off-the-shelf applications, as many banking software vendors are now in a position to deliver built-in AI, for example, machine learning, within their to deliver these capabilities and benefits to those who can't afford large data scientist teams, for example. At the same point in time, we also need to talk about microservices. And yes, some of you may say it's not a technology, and they are right. It's more an architecture, a paradigm within architectures. But I dare to say it's now definitely time to understand that microservices are not something that can be ignored. Many banks work with microservices in a very beneficial way. They use them to support transformation initiatives, and many vendors that have been reluctant to move forward because they have large installed bases are now using microservices to a minor or already to a very large extent to leverage the flexibility that microservices can provide, to deliver domain-oriented services, and also to offer their customers a huge when it comes to bringing together different capabilities from their portfolio and from other portfolios, and also from custom-built applications. With that, let's have a quick look at some examples from on the radar. And here I would like to talk a little bit about AI-powered robotic process automation. And I guess we need to differentiate here between simple RPA that many banks have used more for plumbing because they had to find a way to provide more seamless processes, more automated processes. But what we're also seeing is that some banks definitely generate value with more sophisticated AI-based RPA solutions. Let's also have a quick look at low code. And here, I think we need to differentiate a little bit because some banks are entirely happy with low code. They have even business developers, even citizens developers, building new capabilities with low code environments. On the other hand, there are regulators that are concerned about a not so much regulated area where new applications may come into existence that are not subject to the rules that are typical for a technology team, for an IT organization. Are a little bit, let's say, afraid of vendor lock-in because of these low-code environments. I do not see it that much when it comes to banking software because this is more a way to make banking software more flexible. But it's about a pure low-code vendor environment. It's certainly something that is worth considering how to move the IP away from a given environment if necessary. To talk about one example from the hype area. Let me talk about the metaverse, at least 2 or 3 sentences long. The metaverse is, I think, something that many talk about these days. Many banks are already buying property in the metaverse. But let's be precise. The metaverse is certainly many years out. Metaverses are many years out. And today, we have more what Forrester likes to call a protoverse. Something that is evolving into the direction of a metaverse, but certainly is nothing that already provides value today, right now. It's nothing that a web bank can use to increase its revenue streams as of now. And with that, I guess it is necessary to mention one thing. If we look at all of these emerging technologies, that's examples, we touch base on it, all of the others, we have a unique situation today. We have plenty of emerging technologies that can provide value. This is different to the past where we only had 1 or 2 that were supposed to be the silver bullet technology challenges in banking. And consequently, I dare to say that this unique situation creates a situation characterized by a single sentence that if we combine all of these technologies, magic can happen, because magic happens when you combine things. Thank you very much indeed.
Thank you, Jost, for some really great insights into the key trends that are shaping the future of lending as we know it. These should be truly beneficial for all our attendees on the webinar. And now I invite Dilnisin to take us through how Accenture is aiding this motion.
Okay, thank you. Can you hear me okay?
I can hear you fine.
Okay, perfect. So thank you everyone for joining and for your time. I hope it's going to be also triggering maybe some questions and also answering some of the others. So I would like to continue from where Jost has left it in terms of how we see also the banking and also consumer lending evolving, and what are the different business models and how we are helping our clients, but also what are the other elements we see changing. So on one side, I think the digital native players who came into the market with different propositions, which were more around payments, consumer loans, but not limited with, they have been doing great experiences and brought us, I think, nice experiences, touched our lives, but they were able to do also 2 more things, which is more around product componentization and also value chain fragmentation, because none of the players are trying to serve the full credits as a product, but they're just doing buy now, pay later. They're collaborating with other players for consumer lending. They're trying to just focus on SME lending. And then they're trying to use others or different partnering approach for scaling, because for them, scaling fast is important. So they're also setting up their business model, their technology in order to make sure that scaling fast happens. And we have a lot of examples of how the current banking products, together with cloud, together with APIs and data, have been componentized into different pieces, so that we can see a lot of different players who are owning these different pieces. And then now they're trying to collaborate and bundle with others to bring different things. And I think one important element is they're not trying to sell what is on the shelf, but they're trying to customize the product, which is the tricky point, because most of the examples we see in the traditional banking space is more around, okay, I have this product, can I have a distribution agreement in order to gain more commission and sell it through others instead of really tailoring it. So in terms of the big banks, what we see is there are some critical elements that need to happen internally. Same thing happening also in the consumer lending space in order to move forward and in order to get this agility to play different models. So when we look at the current products, we need to think again, what are the unbundled version of these products? And being able to rebundle them internally to make sure they're relevant for different players and also for them. To have some maybe external components, we see this more maybe some of the mid-sized players, and also when you are trying to enter new markets, because there is also a trend of internalization just digitally, like BBVA moving into Italy with a digital version. And then there's the version which is more like how you can be part of others' models, which is, can you rebundle and sell as a service your products, or can you just be a component within somebody else's product? So, and then we see a lot of the super apps and embedded banking models, which makes the banking look a bit different in the future. So we see that the vertically integrated model of the banks, which is more like a monolithic, I manufacture and I sell only my products, and packaging used to happen a lot in the branches. Digitally, it's less happening. It's going to move forward with all these componentization of products, variety of distributors. So banks will continue playing their vertical model, vertically integrated model, but they're going to have more components or more kind of variety in terms of the way they put together the product and the way they also partner and sell their product. But the main differentiator will be also how you package the value. So it's not just going to be the standalone products you sell, but it's also how you're putting different pieces together, or how you enable others to put it together, and you own the value architecture. And I think one critical element here is banks have a peculiar position because they own balance sheet, and probably banking is the only industry which owns balance sheet and talks with balance sheet. Most of the other industries talk with revenue, turnover, and etc. The power, the knowledge on the balance sheet, which is also driven by credits, is critical. I mean, when we talk with big tech, some of them says we want to do banking, but we don't want to be a bank, so we need banks to be with us to play this game. So together with balance sheet, the other important element is the customer ownership. And if you're playing these models, if you just play the behind the scene model, there is a risk to lose the customer touch. So that's why we believe the middle part will be as important as playing the two parts with the right level of proficiency. In terms of consumer lending and consumer finance, which is all this unsecured lending space together with credit card, there are a number of things changing. The partnership management, the partnership model is changing. The way the value chains and the way the banks are, or the digital players are positioning themselves is changing. Like how many things you're trying to own, can you collaborate, also put together the pieces. Search for value, and we are seeing this not only the financial value, not only the interest rate, but non-financial value of giving access. So like a lot of us probably know that Klarna-like players not only putting together a buy now pay later offer, but also a merchant network that gives access to customers in order to shop with a buy now pay later proposition, but then if you're in the Klarna loop versus not, that might be a decision point. So there is a bundling of different value. There is the part related with revenue. So the way the revenue is being earned is changing, and of course the operating model, because unless you change your operating model to handle this different business models and also partnerships and the profitability, it's not going to work, because it will be more transactional and it's going to be more like responding some of the RFPs that you're trying to win and play one-to-one almost. But we think that it's going to be important to make sure you have an adjusted operating model which will be able to handle multiple models, and of course the customer needs, and making sure it's contextual and it's personalized. And also we see the trend in, again, the consumer finance space. Other industries coming into this space is impacting also the industry. So we see a lot of course, retailers coming into the space, and also consumer goods companies trying to build their marketplaces. But travel, auto finance, and other industries are also coming into the play and forcing the digital providers, both for internalization and also super apps, embedded models with data monetization elements. So we see there are forces both within financial services and other industries triggering all this change. When we look at different models in the context of consumer finance, we see still there's 68% is playing the traditional models, either the vertically integrated one or the distribution only one. But 14% of these traditional players have been already moving to the new models. And the new models is around 32%, which is banking as a service, embedded, and also the packaging models. And this is gonna grow. And the key thing is you don't need to choose one model. The main differentiator will be if you will be able to play an and model rather than an or, and if you will be able to do it at speed, at scale, which will be the differentiator. Because if you try to choose one model or the other, you won't be able to kind of shrink in your existing areas, which is an asset. So we believe banks need to play multiple models at speed and at scale. And it's actually a great moment for this, because a lot of the banks still continue their journeys in terms of digital transformation, in terms of automation, moving to cloud. But when you're thinking about your journey, I think the important thing is whether you're recreating your existing business model in the digital world, so it's more like a X.digital and trying to be your best digital version, or are you adding other elements of this product componentization, value chain fragmentation, together with all the data, zero ops, purpose topics to create another version, which is going to give you more flexibility. And based on our analysis, the players who are able to do it at scale moving forward will have an additional 3.8% growth on top of GDP growth. So that's going to be a big differentiator. And I think it's a great opportunity to use these current journeys to rethink and kind of target something else. And how we are helping in the market and how we are seeing the demand is more around, I mean, three elements. Yes, having this idea of, yes, out of this journey, we need to have something else other than the current version in the digital world. So it's both the product componentization and value chain fragmentation, but together with rethinking your business model and operating model, rethinking the customer journeys enabled with data, making sure data is in the moment, not just at the journey level, process level, and the architecture to make sure the architecture will give the flexibility to play these different roles with an optimized cost, because it can easily be a high cost game. And finally, I mean, I think the question of how ready you are in playing these roles, because there's a great opportunity for further growth and differentiate among many players who are in the market, not necessarily the banking players. Thank you for listening.
Thank you so much, Dilnisin. Definitive guide to the different banking business models and a wonderful insight into Accenture's vision for the future of lending. And now I invite Rajiv to speak about how Newgen is aiding this motion.
Yeah, thank you so much for that. Can you see my screen?
I can.
Yeah, let me just. So thank you all. And while my colleagues from Accenture and Forrester spoke about the trends, I'm going to try and explain a little more on what it means in terms of tooling or technology. Now, translating or managing this explosive growth in lending, especially the newer forms, BNPL, embedded finance, even straight through processing for existing customers, along with all the various changes, some due to the macro environment, like the war in Ukraine, or some due to regulatory change. All this can be broken down in terms of technology into three simple factors. Does your tool successfully determine the intent of the borrower, whether it's a retail, individual, or a corporate, to repay? Whether the tool can assess the ability of the borrower to repay and the speed of execution. Now, these are fundamentals of lending, but I believe that successfully translating or adapting to the trends in automated lending requires a tool to go back to these three basics: intent, ability, and speed. Speed, now this comes down to the three issues at hand. When it comes to intent, what that means is your core banking is largely irrelevant. Your entire lending experience, this automated lending, resides in the customer facing piece, which is largely what we call origination. The origination tool that a financial institution selects in order to fully be part of this automated lending journey should have a very strong underwriting element to it, should be agile, stroke flexible enough to manage your business rules, right? And most importantly, should be seamless. So across devices, across a broken customer journey, lock in the customer, so to speak. Classic cases are Apple. I mean, the other day, a couple of months ago, I walked into the Apple store to just browse a birthday gift for my wife, and I walked out with an iPad Pro. Apple and Barclays have embedded finance at the origination piece, so to speak, and within 10 minutes, you get a decision, you walk out with your product, right? Ability, the ability to repay. How do they know that I can repay? They make use of APIs, they make use of an open banking framework, they make use of fintechs. There are small fintechs there which provide for corporate finance, for example, integration into accounting pieces. Most importantly is speed, right? For many of us, a purchase decision or a loan decision is influenced by the time taken. Second thoughts is very important. You don't want your customer to have second thoughts during an automated lending journey. So as far as possible, straight through or minimal disruption. This means in your origination, having things like the ability to upload documents on the fly through multiple sources, whether it's messaging, whether it's email, whether it's physical, but the key being reduce the time spent by the customer away from the system. Keep him in the journey, keep him or her engaged in the journey to closure. Yeah, so I say the 80-20 rule should become 99-1. Now, what this means and all the wonderful things my colleagues have said, in terms of technology, I believe we've gotten complex. For automated lending, It is all about simplicity. Now, my colleague from Forrester did mention that banks are automating complex journeys. The principle here, we believe, is the journey may be complex, the solution should be as simple as possible. And this translates directly into bottom line and top line. What does that mean? Abandonment rate minimal. Again, from an origination perspective, multiple channels, whether it's a desktop, whether it's a branch, whether it's a smartphone increasingly, or any other mobile device, keep them engaged. Broken experience. Yes, when we are applying for a loan, whether it be online or in branch, we have multiple distractions. Ensure that the customer, the potential client, can come back or re-enter the journey at whatever point they had to leave it. And most importantly, cost and time, which mean things like adopt cloud, right? Use fintechs, move away from capex into opex. My colleague mentioned about low code. Now, this is one of the key components of the Newgen platform, wherein we have moved from a point solution to a platform. Now, this takes care of a lot of features in terms of future proofing, in terms of agility, in terms of scalability. So, for example, when you're talking about the loan origination process, automating the decision cycle, while at the same time making sure that you don't fall foul of regulatory principles, that is best achieved through a platform, a low-code approach. You're talking about things like controlling the workflow of a loan case. Today, it might be A, B, C, D. Tomorrow, it might become A, C, B, D, or A, B, C, C minus 1, D. If you have a hard-coded point solution, this involves going back to the vendor, a lot of time and effort. A platform, a low-code platform, reduces the complexity within a bank, right? Similarly, you have post-dispersal, you have marketing analytics. All these powerful features can be done using a low-code platform. Lastly, in practice, what does all this mean? This means you have new technologies like some of them machine learning, artificial intelligence. How do you seamlessly integrate it into your origination process, into your lending process? How do you ensure that the quality of your leads is high to start with? Reduce fraud, improve product selection, automate back office, mid office tasks, regulatory compliance through strict PEP sanction checks, integration into complex ecosystems. Most banks have multiple silos, using APIs, using open frameworks, and most importantly, ease of deployment, ease of maintainability, ease of usability using the cloud. With that, I come to the end of my 10 minutes. Gunjan, over to you.
Thank you, Rajiv, for the overview of Newgen's lending platform. Yeah, we now have some questions from the audience. Let me take them up one by one. So Jost, Dilnisin, Rajiv, if you can be on video. Perfect. Yeah, so the first question, I'll pose it to Dilnisin. Is the gap between business and IT growing or being bridged with digital innovation?
I mean, I think, yes, definitely there is a bridge, but still the way the business is getting involved into the full picture and how this is kind of coordinated, structured, because we still see some of the initiatives are more driven by, okay, we would like to bring this technology and that technology will have the magic stick to solve all our problems. still exists. And we are usually the ones to make sure business is involved, customers thinking is involved, because I think it's not only business at the moment, it's also understanding the customer needs, understanding what is the value proposition you're trying to create out of that journey, that transformation is important. So you need to have an internal eye on what's the end customer value proposition, because otherwise it's just solving today's problem while the world is changing. So you need to be attentive of whether you're creating your future version and whether your business vision is in, whether your technology capabilities are in, and your customers will like it.
And maybe to add one or two sentences here, if you don't mind. I think what is very important is that we definitely do not, and I guess it's very obvious, that we do not increase, that we do not broaden the gap. Just to the opposite. What I currently see when working with our customers is certainly that some of them, the more leading organizations, are trying to align the business organization with the domain-driven approaches, with the microservices, with the concepts, with the service landscapes that they use on the IT side. The changes on the business side can be not easy, but easier implemented on the technology side. I guess this is a very important thing, something that many banks will need to implement to remain competitive in these situations characterized by ecosystems.
Thank you, Jost. Wonderfully said. And Rajiv, one question that normally crops up, I think this has come in quite often, that regulation is ever increasing. And how does a platform approach exactly address this?
That's an interesting concept. Okay, yeah, regulation has increased. I mean, Basel I was what, 10 pages, and Basel IV is going to be 600 pages, I think so. Now, that was something which I alluded to in my presentation. My colleagues also mentioned it tangentially. A platform approach means that changes, accommodating changes, is in quotes vendor agnostic. So you're not vendor dependent. You're no longer dependent on the vendor to implement code level changes. It's configurability. If you look at the new regulations which are coming on, whether they are accounting, whether they are compliance, whether they are related to risk, many of them are enhancements or they build upon previous regulations. Very rarely do you see something come out of the blue. Okay, now in the current landscape, many banks, because of the investments they've done in risk and compliance divisions, which quite often are gigantic, is their systems are so hard-coded that changing them is a project in itself, a mammoth project. Now, if you invest in a platform, let's say for lending, right? We have found from experience that a lot of the regulatory changes can be handled at that level itself rather than go to the core system. So I do believe a platform approach is the way, and quite a few financial institutions I've noticed are adopting it already. One of the key things, for example, would be GDPR. We find that in lending, a lot of the GDPR can be done much more cost effectively in a much more timely fashion if your system of customer contact rather than your core handles it. It's configurable enough to handle it.
Okay. Thank you, Rajiv. And I'll just take one final question. And I think this is a question that I can. What is that one thing that lending executives and technologists should be thinking about now and strategizing for to be prepared for the world in 5 years' time? Jost, we can start with you.
I guess there's not just one response here. I think first and foremost, it's certainly about being able to design lending capabilities, new lending capabilities, in a way that they can collaborate with other solutions, with other systems, with other capabilities. What do I mean by that? Even if it's within a bank, the lending solution will need to work with other capabilities in a much more easier and more flexible way to simply drive change. Then it's certainly about ecosystems. Again, you're not surprised I'm saying that, right? So it's about designing lending solutions in a way that part of an ecosystem, that they can contribute, that they can be hooked into a marketplace, that they can use external capabilities, for example, for customer identification, you name these things. Same point in time, it's certainly also about making sure that these lending systems, and this is not only true for lending systems, but that systems that need to be active in such a kind of highly networked, meshed environment like the banking ecosystem, that they are focusing on what Forrester has started calling zero trust many years ago, so that the systems by themselves can work in a networked environment in a secure fashion without any additional risk. And this is one aspect. The other aspect is certainly about regulation. And I think they need to be designed in a way, and Rajiv already mentioned this, that they can cope with future regulation in a much more, this will change the banking space because it will make life easier for banks. Banks will be able to refocus investments. At the same point in time, it will also change the banking software industry, because right now we're certainly seeing some, not all, some banking software vendors with a huge revenue stream coming from new compliance solutions, because they have to add one turret here, one window there, etc., etc. And if we would create more flexible systems, this revenue stream will not dry up probably, but it will certainly be reduced.
Thank you, Jost. Dilnisin, your views on it?
Yeah, I think agree. It's not going to be just one dimension, but one starting point is customer and balance sheet power is important. So the banks needs to make sure they don't lose the customer touch, and they use their balance sheet power in order to scale and in order to play different models. The other, as the journeys are still going on, how they're going to use this period to really create that ability to scale fast and have more options to play different models. And both because they need to continue their role as a bank. I mean, all the economy, all the span, we are talking about inflation, we are talking about interest, cost of living, and people will be spending less, and etc. So within this context, banks need to continue lending money with their knowledge, and then they need to still be ethical, but do their transformation as well. So customer focus, making sure the balance sheet power, the risk awareness, and etc. is there, but all run with data, with cost-effective ways, and everything coming into a new business model capability.
Finally, Rajiv, your take on this?
Well, as a technology vendor, the one word which I have for all my prospects to think about the next 5 years or what's going to drive lending is your competition. It's put very simply. Some years ago, who thought BNPL, buy now, pay later, would take off? Nowadays, embedded finance. Who's thought about that? So I always ask lending executives whom I'm pitching to, you don't know what your future is going to be. Tomorrow, Apple might be the biggest bank in the world, for all you know. So how do your business, you might have business ways, ideas to compete, but if your technology cannot support your business, whatever it might be in 5 years from now, there's no use of having the best idea. So I always request my clients and prospects, when selecting a system or systems 5 years ahead, think of what your competition could be in your wildest dreams and buy accordingly.
Oh, wonderful insight, Rajiv. So thank you, Jost, Dilnisin, and Rajiv. We really appreciate your time and valuable insights. We thank Forrester and our partner in Accenture for all their support. do expect an email from us with a copy of the recording to all the attendees. Those who are not able to share the questions today, please feel free to send them over via email. If you are interested to know more, or if you want to see our loan origination platform in action, do visit our website or write to us at info@newgensoft.com. Thank you again, all of you, and have a great rest of the day ahead.
Thank you.
Thank you.
Bye.